The chair of the Federal Reserve, Jay Powell, acknowledged today that he and the wider Federal Reserve Board had underestimated the threat of inflation last year. But with the annual inflation rate now closing in on 8%, that attitude has changed. And Powell committed to ramping up a fight against ever rising prices beyond what had even been projected. John Yang has the story.
Judy, today's rate increase and the prospect of more to come this year is a sharp reversal from just 2 years ago when the Fed cut rates to near zero to support the economy as the pandemic shut much of it down. Nick Timiraos is the Wall Street Journal's chief economics correspondent. He's author of a new book on the Fed's response to the pandemic, Trillion-Dollar Triage. Nick, thanks so much for joining us. Today's quarter point increase was widely expected, but the roadmap ahead of the prospect of more increases through this year was not. How much more aggressive is this Fed stance than what had been anticipated, and what's the Fed trying to accomplish here?
Well, it is more aggressive than what had been anticipated, though investors in bond markets had begun to sense the Fed might raise rates at every meeting this year, and that is what the Fed projected this meeting today. They said they could raise rates at their 6 remaining meetings this year. That would be a faster pace of increases than since 2005. The problem here is that supply and demand are out of whack. And as you mentioned, the Fed misjudged this last year, and so now they're trying to catch up.
And how is this going to affect average Americans? Mortgage rates, car loan rates, credit card rates?
Even before the Fed raised interest rates today, you had seen borrowing costs go up because the Fed had effectively signaled they were going to do this. So mortgage rates have gone up by more than a percentage point in just the last 2 months. You're seeing it's getting more expensive for businesses to borrow in the corporate bond market. And that should continue as the Fed becomes more and more hawkish about dealing with these supply and demand imbalances. You know, the Fed can't do anything about busted supply chains, but they can fix demand. They can reduce demand. And that is what higher interest rates eventually will do. They will reduce job growth, slow the pace of wage growth. That is how the Fed fights inflation. When Jay Powell says we will use our tools, he's talking about slowing economic growth.
What did Powell say about how does he assess the risks of what's going on in Ukraine and the geopolitical situation?
Yeah, it's a tough time for the Fed because they had been counting on supply chains improving. At the beginning of the year, they thought inflation would come down largely as these bottlenecks eased. And it's a little bit like the Mike Tyson quote, everybody has a plan until they get punched in the face. And what the Ukraine war does to the Fed, it's a blow because you now have more disruption in supply chains, oil prices, commodity prices. And on top of that, you have China, large parts of China, manufacturing hubs going back into lockdown. So that will keep pressure on inflation for longer than the Fed was anticipating. And at a certain point, 9%, 10% inflation, the Fed will get concerned that consumers and businesses will expect prices to be high for longer. And that is how you start a wage price spiral that we don't want to have in this country.
We've heard some economists, Larry Summers, the former Treasury Secretary among them, say that this is too little too late to really fight inflation. And then today you had on Wall Street traders saying that it was too much, that it could tip the economy into a recession. What did Powell have to say about those criticisms?
Well, Powell was asked about whether this would, whether there was a rising risk of a recession. And as one analyst put it, the fact he's even being asked the question isn't great. If the Fed chair has to say no recession, it suggests that the risk is rising somewhat. I think the takeaway, though, from all of this is that if you look back 2 years, I write about this in my book, 2 years ago when the pandemic was bringing commerce to a halt, Powell got after his colleagues a little bit and said, it feels like we're swimming after a speedboat. We need to do more. We need to get ahead of this. And it seems as if right now the Fed is in a similar place, obviously with the risks coming from the completely opposite direction. They need to find that gear where they can get interest rates up faster, but not so fast that they crash the plane here and you have a hard landing.
Nick Timiraos of the Wall Street Journal, thank you very much.
Thanks for having me.